Hello and welcome to another video. In today's video, I'm discussing about top 5 dividend stocks for 2024. Without any delay, let's go. In our first stock is Walt Disney Company, DS, stock. Walt Disney Company, DIS, is often considered a solid choice for dividend investors for several reasons. Number 1. Consistent dividend history. Disney has a long history of paying dividends to its shareholders, dating back many decades. The company has maintained its commitment to returning value to shareholders through regular dividend payments, demonstrating its reliability in providing income to investors. Number 2. Dividend growth. In addition to consistently paying dividends, Disney has a track record of increasing its dividend payout over time. This dividend growth signals confidence in the company's financial health and future prospects, making it attractive to investors seeking income growth along with stability. Number 3. Diverse revenue streams. Disney operates in multiple segments, including media networks, parks and resorts, studio entertainment, and consumer products. This diversification provides Disney with multiple sources of revenue, which can support its ability to continue paying dividends even during challenging economic conditions. Number 4. Iconic brands and intellectual properties. Disney owns some of the most valuable and beloved brands and intellectual properties in the world, including Disney, Pixar, Marvel, Star Wars, and National Geographic. These brands have enduring popularity and contribute to Disney's strong financial performance, which in turn supports its dividend payments. Number 5. Stable and resilient business model. Despite economic downturns or fluctuations, Disney's core businesses, such as theme parks, media networks, and consumer products, have demonstrated resilience. The demand for Disney's content and experiences remains relatively stable over the long term, providing a reliable revenue stream to support dividend payments. Number 6. Strategic acquisitions and investments. Disney has a history of making strategic acquisitions and investments to expand its content library, global reach, and competitive position. Recent acquisitions such as Pixar, Marvel, Lucasfilm, and 21st Century Fox have further strengthened Disney's portfolio and growth prospects, enhancing its ability to generate cash flow to support dividends. Number 7. Commitment to shareholder returns. Disney's management team has demonstrated a commitment to creating value for shareholders through dividends and share buybacks. By returning capital to shareholders, Disney aligns its interests with those of investors and reinforces its dedication to delivering long-term shareholder value. Number 8. Positive outlook for streaming services. Disney's direct-to-consumer streaming services, including Disney+, Hulu, and ESPN+, have experienced rapid growth and are expected to become significant revenue drivers in the future. As these streaming platforms continue to gain subscribers and generate revenue, they could contribute to Disney's ability to maintain and potentially increase dividend payments. Overall, Disney's combination of strong brands, diverse revenue streams, resilient business model, and commitment to shareholder returns make it an attractive choice for dividend investors seeking a stable income stream with the potential for growth. However, it's essential to conduct thorough research, monitor Disney's financial performance and industry trends, and consider consulting with a financial advisor before making investment decisions. In our second stock is JEPI stock. JEPI, or JP Morgan Equity Premium Income ETF, is an exchange-traded fund, ETF, that seeks to provide income through a combination of dividend payments and option premiums. While it's not a traditional dividend stock, it can still be appealing to dividend investors for several reasons. Number 1. High dividend yield. JEPI aims to generate income by investing in dividend-paying stocks, which typically offer higher yields than bonds or other fixed-income securities. By focusing on stocks with attractive dividend yields, JEPI provides investors with a potentially higher income stream compared to traditional dividend stocks. Number 2. Option premiums. In addition to dividend income, JEPI employs a covered call strategy to enhance its yield. This strategy involves selling call options on the stocks held in the portfolio, generating additional income in the form of option premiums. By leveraging options, JEPI aims to boost its overall income potential and provide investors with a more attractive total return. Number 3. Diversification. JEPI invests in a diversified portfolio of large-cap U.S. stocks, providing investors with exposure to a broad range of industries and sectors. This diversification helps reduce risk by spreading exposure across multiple companies and sectors, potentially enhancing the stability of the income stream generated by the ETF. Number 4. Active management. JEPI is actively managed by experienced portfolio managers who select dividend-paying stocks and implement covered call strategies based on market conditions and outlook. This active management approach allows JEPI to adapt to changing market dynamics and optimize its income generation potential over time. Number 5. Lower volatility. While dividend stocks can be subject to market volatility, the covered call strategy employed by JEPI can help mitigate volatility to some extent. By selling call options on the stocks held in the portfolio, JEPI generates additional income while potentially reducing downside risk during periods of market volatility. Number 6. Potential for capital appreciation. In addition to income generation, JEPI offers the potential for capital appreciation as the value of the underlying stocks in the portfolio increases over time. While capital gains are not the primary focus of JEPI, they can still contribute to the total return generated by the ETF. Number 7. Competitive expense ratio. JEPI has a competitive expense ratio compared to actively managed mutual funds and other investment vehicles, making it a cost-effective option for investors seeking income with the potential for capital appreciation. Overall, JEPI offers dividend investors a unique opportunity to generate income through a combination of dividend payments and option premiums while providing exposure to a diversified portfolio of dividend-paying stocks. However, it's essential for investors to carefully consider their investment objectives, risk tolerance, and investment horizon before investing in JEPI or any other ETF. Consulting with a financial advisor can also help ensure that JEPI aligns with your overall investment strategy and goals. In our third stock is T. Rowe Price Group Incorporated, TROW, stock. T. Rowe Price Group Incorporated, TROW, is often considered one of the best dividend stocks for several reasons. Number 1. Consistent dividend growth. TROW has a long track record of paying dividends and increasing its dividend payout over time. The company has consistently raised its dividend for over 3 decades, demonstrating its commitment to returning value to shareholders and its confidence in its financial strength and future prospects. Number 2. Strong financial performance. TROW is a leading asset management firm with a strong financial position and stable earnings. The company's diversified revenue streams, including investment advisory fees, account maintenance fees, and distribution and servicing fees, provide a reliable source of cash flow to support dividend payments. Number 3. Stable and predictable business model. As an asset management firm, TROW's business model is relatively stable and predictable, with revenue streams tied to assets under management, AUM, and investment performance. Despite market fluctuations, TROW's revenue tends to be resilient, providing a solid foundation for consistent dividend payments. Number 4. Focus on shareholder returns. TROW prioritizes returning capital to shareholders through dividends and share buybacks. The company's management team is committed to maximizing shareholder value and has a history of implementing shareholder-friendly initiatives, such as returning excess cash to investors through dividends. Number 5. Attractive dividend yield. TROW offers an attractive dividend yield compared to many other dividend stocks and fixed-income investments. The company's consistent dividend growth and competitive yield make it an appealing choice for income-oriented investors seeking a reliable income stream. Number 6. Robust investment performance. TROW's investment management expertise and track record of delivering strong investment performance have contributed to its ability to attract and retain clients. The company's reputation for delivering value to investors enhances its long-term growth prospects and supports its ability to sustain and grow its dividend over time. Number 7. Well-managed company. TROW is known for its strong corporate governance, prudent risk management, and disciplined capital allocation strategies. The company's management team has a history of making sound business decisions and navigating challenging market conditions effectively, which instills confidence in investors regarding the sustainability of its dividend payments. Number 8. Industry leadership and reputation. TROW is recognized as a leader in the asset management industry, with a reputation for integrity, professionalism, and client service. Its strong brand and market position contribute to its ability to attract and retain clients, which, in turn, supports its revenue growth and dividend payments. Overall, T. Rowe Price Group Incorporated stands out as one of the best dividend stocks due to its consistent dividend growth, strong financial performance, shareholder-focused management, and industry leadership. While past performance is not indicative of future results, TROW's track record and reputation make it a compelling choice for income-oriented investors seeking both dividend income and long-term capital appreciation. And the last stock is ProShares Ultra Pro Short QQQ ETF. It's important to clarify that SQQQ, the ProShares Ultra Pro Short QQQ ETF, is not a dividend stock. In fact, it's quite the opposite. SQQQ is a leveraged exchange-traded fund, ETF, designed to provide investors with 3 times the daily inverse performance of the Nasdaq 100 index. Here are some reasons why SQQQ is not suitable for dividend investors. Number 1. Inverse performance. SQQQ aims to deliver 3 times the opposite daily return of the Nasdaq 100 index. This means that when the Nasdaq 100 index goes down, SQQQ goes up, and vice versa. It's a trading tool used by investors who want to profit from short-term declines in the Nasdaq 100 index, rather than by those seeking dividend income. Number 2. Leveraged product. SQQQ is a leveraged ETF, meaning it uses financial derivatives and debt to amplify the returns of its underlying index. While leverage can magnify gains in the short term, it also increases the risk of significant losses, especially if held for an extended period. Leveraged ETFs like SQQQ are not designed for long-term investing or income generation. Number 3. High volatility. Due to its leveraged nature, SQQQ experiences amplified volatility compared to the underlying index. This volatility can lead to rapid price fluctuations and increased risk for investors, making it unsuitable for those seeking stable dividend income. Number 4. No dividend payments. Unlike traditional dividend stocks, SQQQ does not pay dividends to its shareholders. Instead, it seeks to provide returns based on the inverse performance of the Nasdaq 100 index. Investors looking for dividend income should focus on stocks or ETFs that explicitly prioritize dividend payments. Number 5. Short-term trading tool. SQQQ is primarily used by traders and investors looking to hedge against or profit from short-term market declines. It is not intended for buy-and-hold strategies or income generation through dividends. In summary, SQQQ is not a suitable investment for dividend investors. It is a leveraged ETF designed for short-term trading purposes, and its performance is based on the inverse movement of the Nasdaq 100 index. Investors seeking dividend income should instead consider traditional dividend stocks or dividend-focused ETFs that prioritize regular dividend payments and long-term capital appreciation. Thank you for watching. I hope you will like this video.